Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. I am Andrew Hall. Joining me today is Ben Nye. And Ben, today we're here to talk about American Express, a company that we at Narwhal Capital Management own, ticker AXP. Let's talk about their earnings a little bit. What were the big headlines, the things that stood out the most to you?
Big headline was, we just talked about Unilever, but American Express also had a big investor day just a couple weeks ago too. And they came out with all their commentary and so people weren't really expecting much new in this earnings report, but they beat on revenue and they beat on EPS. The EPS beat was, you'd kind of expect from a company because you can massage numbers a little bit. The tax rate was a little lower, 32% versus full year expectation of 33 to 34%. But revenue beat by $100 million, 7.9 versus estimate of 7.8 billion, and that is a positive for a company that is perceived to be under pressure on the revenue side after losing the Costco deal from last year. So that was a definite positive, and as you would expect, based on their last public comments, most of that acceleration came in March. So the optimism here is that that will continue, and that will continue into Q2 and for the balance of the year. So an optimistic tone from management, optimistic tone from the quarter, and I think that's why you're seeing the run up in the stock price today.
Got my tennis shoes on camera. Sorry. We're trying out the new camera. Scotty's making me nervous when he starts laughing. I don't know what he's zooming in on. Interesting story, as you said, kind of that positive tone, I think was the big read-through for me. It seems like every week there's some kind of article in a financial publication of some kind talking about American Express kind of losing its luster as an actual membership program, and that prestige is going elsewhere. Millennials don't like it; they like this program instead. So kind of interesting to see that uptick so late in the quarter. Still giving pretty strong guidance when you look at what the stock has done historically and kind of the multiples that it typically trades at. So coming in at that 560 to 580 range, they didn't up that. They kind of remain right there. How do they get there throughout the course of the year? Obviously, again, revenue beat in Q1, but something I guess of a soft beat, I would say, with little things like tax plan coming into play. Is this an execution story, or are there broader forces at play?
Well, I think if their revenue continues to come in like it's come in for this quarter, and honestly last quarter as well. The last quarter was negatively impacted by the additional expenses they had. But if revenue continues to come in the way it has, I think you have a great chance at really realizing that operating leverage, and I think there's even a possibility that they raise that range throughout the year. I think they don't want, if you look at some of their things, there's an analyst on the conference call who said, why aren't you modifying your guidance after a Q1 comp over a difficult period from last year? And management responds saying, in terms of our guidance for the year, I guess I'd come back to what I said earlier in my earlier remarks. We feel really good about the start we're off to, but gosh, it's only one quarter and we have a lot of work to do as we go through the year. Certainly we're encouraged by the revenue performance, and I would say based on the first quarter, I think it's much likelier that we'll be at the higher end of revenue range, which was for that adjusted revenue growth to be 5 to 6%. Still looking for a little bit more time to pass before we convert that into what that might mean for EPS. So I actually think that the 560 to 580 in estimate in the guidance may actually be conservative, and that emboldens me, and I think that there's a margin of safety in American Express that may be absent from a lot of other companies at the moment.
And certainly not one that you would have expected this time a year ago.
No.
When it kind of seemed like bad news, Costco.
Right.
It really seemed like the stock that might be reeling. We from our perspective, we almost wondered if it was, almost a company in distress. A cheap company, but, one that was really facing strong headwinds nonetheless. thoughts.
Yeah, and another thing that I was really pleased about was that last quarter, American Express was talking about how they're going to continue to spend a lot of money on marketing and promotion to make sure that they get those new American Express members to generate that revenue growth. Interestingly, on both a year-over-year and a quarter-over-quarter basis, that marketing and promotion expense was actually down. Which I actually view as a positive, because it means that American Express doesn't feel compelled to pour out those additional marketing expenses in order to attract those new members. Instead, a lot of those expenses are going into member rewards, and you could say, well, they need that just to retain customers now, but the majority of that has to do with the new rewards they've unveiled in the Platinum service, and the fees for the higher fees from Platinum don't come into effect until September. So you might see a gap between those fees and the expense line over the next 6 months, but I think after that you'll see those operating margins continue to improve. This is a capital light business, 26% return on invested capital, and at a valuation where it is today, it's, to me, quite attractive.
Very good. Any other closing thoughts?
I think we hit about it.
All right, perfect. This is the Investing Podcast. Check us out on Twitter, twitter.com/TuskMediaLLC, Facebook.com/TuskMediaLLC. All our stuff's on YouTube, also youtube.com/TuskMediaLLC. We will talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.